All right, so we have a lot to do today. So you got your paper one back. You see how I submit it. Hopefully you're okay with getting a rubric like that. Um, so we can fix some of the paper ones, especially those that had some major points taken off that you want to get back. I can't fix the exam. So the exam is the exam. So once you finish the exam, so we got to make sure if you struggle on the paper, you can fix it, resubmit. You can do that anytime between now and the end of the semester. So it's not like I need it immediately. But the exam is the exam, right? Once you walk into the exam, I had someone make a 0 on my exam last semester. And afterwards, they were like, what can I do? What can I do? The exams are exams, like, because what happens if I do something for one student? I could do it for all students. Am I going to do that for final exams? No way. I've got 200 students. This is not possible. So, all right. So here's the rules for the paper redo. You can resubmit anything and get as much as 85%. So if you made a 40 on something, you can resubmit get 85, with one exception. Except revenue growth, you can get 100%. Why? Because that was the easiest one, and probably 5 or 6 people completely forgot to do it. And why did they forget to do it? I warned y'all about it. There's no chart. What's going to happen in the exam on Tuesday? You forget. You get 0, right? What's going to happen today in your team competition if you forget? You get 0, all right? So who's going to forget to talk about revenue growth? It's like the easiest thing of all, isn't it, in the entire thing? But there's no chart, all right? So I'll give you 100% on that, mainly so you go back and do it. Questions on that part? When you resubmit, you must highlight what you want me to grade, all right? Guess what? I'm not going to reread your entire paper again. Just don't have that kind of time in the semester. So you have to, if you email me, here's my regrade, and you don't have anything highlighted, I won't do anything with it, all right? I'll set up something on Canvas for the resubmits, and so you'll see where that is. Questions on that? If I said I did not see a business breakdown, then you either highlight what it was in paper one, add to paper one, and highlight or submit summary separately. All right, so some of y'all couldn't tell if you did anything from business height, business breakdown. So you can, that's application one. So you can, it's technically not due until later, but so if I couldn't tell, some of y'all you might have, but you didn't say it was from business breakdown. You're just kind of talking about it. So some of y'all could tell really, really well. Some of y'all had some really, really good quotes, but some I couldn't really tell. And so due by, I don't know, week before grades are due. So you essentially have the entire semester to do that. Questions? Why do I do the 85%? Well, part of it, someone got like 95%, so they want to resubmit, so their grade on the paper goes up by 0.1%. And it's like, yeah, don't be so obsessed about grades on that. So, just so the 85 should help those that really struggle, because a lot of people that struggle, it was really 3 or 4 things that really, really killed them, and they're okay and everything else. So the 85 will help them dramatically. So, all right. I'll save that. Now, I'm going to try to convince you that paper one wasn't as hard as some were trying to make it. So let's do before we do the team case, let's do a summary of it. So you have short-term viability. So there we're looking at liquidity, solvency, and a summary. So your first one should be really straightforward. Sorry, Bill Gates does this strange thing where he has all these extra spaces. So the first one's real simple. It's CFO growth. Is it high or low? 3%, 12%, negative 4%, straightforward. You might look at the graph and see there's something unusual, like, wow, you can tell COVID impacted or whatever, but basically just tell me, did they have good CFO growth? This is one a lot of y'all struggled on, but as we knew, net working capital requirement. If the graph is negative, it's a source. If positive, it's a use. So just look at the graph. Is the line above the line or below the line? If it's negative, it's a source. That means they have no trouble with liquidity. So above the line, it's a use. That doesn't mean they're disaster on liquidity. That means they're normal. So then you're going to look at the trend. All right. And then improved liquidity is the line going down. That's true for everybody. Doesn't matter whether it's a source or a use. You remember if the line's coming down, their liquidity is getting better. Everybody remember that? And then the next one, I agree, is a little tough. That is on investor cash flows. Let me just tell you I probably should have done this earlier. Let me tell you the several scenarios. Large outflows to investors and continued high CapEx. That's the best story. They're sending a lot of money to their investors and they're doing a lot of CapEx. That's a firm that's doing what? Great free cash flow. No question, right? They're doing everything. Here, hey, investors, here's money back, but we're also keeping a lot of money and reinvesting in the firm. We just got billions of dollars. They must be producing a lot of cash flow. Large outflows with falling CapEx, still good, but some of the disbursements are lowered reinvesting in the firm. So it's not horrible, but you're not as sure because they're sending a lot of money to investors, but also cutting back on their reinvestments. So maybe they're producing free cash flow, but it's maybe not as strong as the disbursements look. All right. Large outflows, but huge drop in CapEx. Why is that wrong? Isn't how you spell huge? Oh no, it's E. Probably more reduced reinvestment in free cash flow. You look at, wow, they're sending a lot of money to their stockholders. Oh, wait a minute. They just stopped reinvesting in the firm. They've run out of ideas. They're producing good cash flows, but it's not that is as strong as the disbursements looks. They just cut back on the firm. Low or actual inflows. They're issuing stock on borrowing. Then that is not good free cash flow. Yeah, so if that line is below the line, so they're actually bringing money in. Remember, above the line, it means they're just distributing. If it's below the line, they're actually bringing money in. They can't be producing free cash flow if they have to go to the stock and bond market to get money. I do know how to spell and type, but not when I'm talking. Now, what could be the one kind of caveat to this? If huge CapEx could be young, fast-growing company. Well, You're probably not going to see that because I really can't put a company like that on the exam because their number is going to be a mess. But sometimes you see a firm that's borrowing a lot, issuing a lot of stock, and doing a lot of CapEx. Why? Because it's a new firm and it's growing fast. Obviously, they're not producing free cash flow because they're not at that stage of the business yet. We don't usually look at that negative. We just are worried how long you're going to have to borrow money. You saw that with Netflix several years ago, where they're just like borrowing a lot of money because they're building up all that production. All right. So this one's a little tough. Questions on this? It's on the exam. I can give you something so bizarre it gets too difficult. So it's going to be a more straightforward firm. So Coca-Cola is a good example. Coca-Cola, no question, they're producing a lot of free cash flow, but they're not doing a lot of reinvestment because they don't really have much to do. We're not drinking sodas. There's not much they can do, but they're producing a lot of cash. That's great. It's great for their investors. All right. On solvency, you got times interest earned. You just say, is it above 10? You're good. It's not above 10. You just look at the trend and see if they're getting better or worse. I said a few of your firms are like at 5 for a while, and they recently came back up to 10. So you can, mention it was weak, but now it's strong again. Some of y'all forgot, we talked about this several times in the class. If times interest earned is a negative number, you don't even put the chart in. They obviously have no problem. It says negative number, that means their investment income is greater than their interest income is greater than their interest expense. Obviously, they're not having trouble covering their debt if they're covering it just with their interest income. Unlikely I'm going to give a company with negative times interest earned, so you don't have to worry about that. So just look at, is it above 10 or not? It's above 10, you almost don't even care where it is versus the industry or anything else, but you just kind of look at it. And then debt to EBITDA, lower is better, and at or below industry. That one's pretty straightforward. Are they in line with the industry, or they're well above, well below? You can also look at the trend, but pretty straightforward. Lower is better, and you want to be below the industry. So that one should be a simple one. Most of y'all were okay on that one. And in the summary, you're going to talk about quality of earnings, which most part, some of y'all were not really understanding this, but all we're saying here is our net income and CFO generally moving together. So what are you looking for there? On that one, you have the net income in there and then all the adjustments to get the CFO. If you see a lot of stuff under the line, especially big things, that's when you get worried, because if management's lying, they're going to have to do something that's going to help net income that's going to hurt CFOs. So that one's a tough one to talk about. And you look at credit ratings. On credit ratings, I'll give you the definitions so you'll have that. But essentially, the summary is a quick summary of liquidity. So just real quickly restate. If you said their liquidity was good, just say that again. If you said their debt was in line or coming down or whatever, you can say that again. All right. So this is probably the hardest one, but if you get this much, you'll probably get almost full credit because it's just, it's positive or negative. This one's a little more complicated because there's so many different combinations, and then we go to long-term growth prospects. And this is the one so many of y'all forgot. This revenue growth. It's the easiest one of all. It's the one that's most forgotten. So you just have to make sure you got that. So is it strong? Is it weak? The second one, a lot of people struggle with. So, you have to, for your company, you got to pick one. So some of y'all did revenue per square foot, but your firm doesn't have square feet. So you can't do that. So you don't say, my firm doesn't have square foot, so you don't have to even mention that. You just say, hey, their revenue per property, plant, equipment, whatever it is. So you don't have to explain why you're not using square feet if you're Meta or somebody. So then you're looking at the source of the growth. Turnover or margin. So if you do revenue per employee, did the revenue employee grow and then the employee count grow? Revenue per employee is which of those? Turnover or, I'm sorry, excuse me. Well, capacity, excuse me. So revenue per employee, is that the turnover or the capacity? Revenue per employee. Oh, turnover. And then the growth in employees is capacity. All right. You're trying to see. So with Walmart, they had like 2% growth in revenue, but over half of that came from adding more square feet, and very little of it came from improvement. There's a lot of combinations here. Any decent number here is great. So remember, you're not looking at which one's higher. 3%, 4% is here, even if this is 10%. So is this a decent number? You can say, yeah, most of the growth is coming from added capacity, but they had some good turnover. So they added 20% more employees, but the revenue per employee is up 4%. That's pretty good. Now, some of y'all had negative turnover and positive capacity. So revenue per employee was down 3%, but employees are 4%. And they would say most of the growth is coming from capacity. But what is the truth? All of the growth is coming from capacity because the revenue per employee is down. So if your turnover is negative, all of the growth is coming from added capacity. All right. So then we have, so there's turnover. Should have put that there. And then you have margins. Oh, and then you have the last one, just ATO. ATO is simple. Higher is better. Look at the trend versus industry. That's just like debt to EBITDA. You just, except for higher is better. So just, are you better in industry? Is it going up? Is it coming down? Is it flat? And then on margins, again, margin's the easiest one. You got gross and you have net. Exact same thing. You're looking at the higher. That can essentially just copy it, right? Exact same thing again. Then you have the summary, which is ATO times margin. And here you're just saying trend versus industry and quick summary of which is doing what between turnover and margin. So you just go back and look at those charts. Wow, asset turnover is flat, but margin's improving. So ATO tells margins going up because margins are going up. Or margins are flat, ATO has been falling. So ATO tells margins falling because turnover is falling. All right, just go back and look at those two charts and try to figure out what's going on there. Then you have the overall summary. This one's tough, but just have to see what you get. So you're looking at return on equity and combined financial leverage. And it's essentially you're going back to that ATO times margin chart. Is that what's driving the ROE, or is it leverage that's driving it? You're trying to figure out between charts 14 and 15, which one's really driving that chart ROE. It's a tough one. It can be ROE's up because ATO is improving, but it's also up because leverage is up. You're kind of just trying to assess what's going on here. If ROE is going up because leverage is going up, that's not good. If ROE is going up because ATO and margin are going up, that's great. But you have to look at all those different combinations. So there are parts in here that are really hard, but there are parts in here that are really simple, like gross margin, net margin, ATO. They're really, really just simple. You're just looking at the chart and just describing higher is better versus the industry. So don't miss the easy ones. The hard ones, do your best. And that's maybe where you go back and listen to the lecture and get a little bit, kind of refreshed, read the class notes. Any questions on all of that? So let's do our team competition. So today, all we're going to do is turnover, so it shouldn't take too long.
The test is next Tuesday or Thursday?
There's next Thursday. Oh, and on the test, I want to get y'all more time, so I'm gonna try my best if I can. We'll see. I'll let y'all know this weekend or Thursday maybe. I'm gonna try to get the FSC because we can fit in the FSC, and then we can start earlier and go longer. If you have a class before, you can come in and stay later. If you have class afterwards, or if you class before and after, you can still get there early and leave a little late, and pick up some time. Um, so I'll let y'all know. I think Dr. Baynott will let me do that because it's the Thursday before spring break, so I doubt there's going to be 20 people in there.
You say we can have our project one with that test?
Yeah, you can have your project one open, right?
Oh, with the exam?
Yeah, with the exam. Yeah, it's not open notes, but you can let your project be your guide.
It kind of sounds like we can do like project one by memory with each company. That's like the best way to prep for the exam.
Yeah, it's time's an issue, so you want to study for it as if it's closed book. But you do have your project to go back and look at if you forget something. Yeah. And you'll have the charts. So the charts are going to help you with everything but the revenue growth. So the charts will help you because I'm not going to give you a chart you don't talk about. It's not going to throw some bizarre chart in the middle of this to throw you off. So every chart in there, you're going to say something about, and you need to add the revenue growth in there. Someone's going to forget to talk about revenue growth. That's just the way exam anxiety is. And so I don't know. I'll just keep whispering revenue during the exam. All right, so break up in your teams. This is a good practice for the exam. So you have the two charts, wherever it is. I don't see them. Why don't I see them? There they are. So chart 9 and chart 10. That's all you're talking about here, plus the revenue growth. All right. So in your teams, I'll type mine and then we can compare afterwards. All right. Now you should have the page 1 printout, right? That's where you can get the revenue growth. So make sure you have that. It is at the bottom of this if you need it there. Now turning to long-term prospects for growth, starting with turnover, we see BF's had 3.45% growth in revenue. This is decent, though not spectacular. Would y'all agree? 3.45. You're gonna say, wow, this is the greatest company in the world. Probably not. What would you say if that was NVIDIA's number last week? Be pretty, I mean, they're up like 7-fold, right? I mean, this is crazy. So yeah, you'd want to know what that was, and we don't have it on exam. What was Budweiser? What was all these other companies? You kind of be curious in that. Budweiser might have been negative. Who knows? All right, and then we're going to turn to the revenue per employee. I want to assess where this revenue growth is coming from. Revenue growth is coming from improved turnover or increased capacity. We can see that revenue per employee grew only 1.23% the past 10 years, while number of employees grew 2.39%. Very little growth is coming from improved turnover, though employee growth has been muted as well. The revenue per employee has consistently been above the median of this industry and recently has shown good improvement. Did y'all notice that? Yeah. That's pretty good, right? It's the highest it's ever been. Jumping to 836 in 2021. It will be interesting to see if they can maintain and improve that next year. When I see a firm, on a trend, that gets me excited because investing, that's what we're looking for. A firm that's been static and suddenly something's improved. That's pretty good. So they're finally back to where they were in 2013. That's not great, but it's at least they crossed that point. PF's asset turnover has been in line with this industry and rather static since 2016. The only positive here is the improvement in 2021, back up 0.6 and more in line with 2016-18. Finding ways to improve turnover should be a focus. This type of firm, it's either going to be new markets or new products in existing markets. That's what they got to do. I don't know exactly what they're selling, but is there a particular alcoholic beverage that's, they've been getting in trouble with the, what do you call those things? The fruit flavored ones or whatever. The ones that are appealing to teenagers. Yeah. Yeah. Those are, I don't know if those have been a growth area, but also have gotten a lot of regulatory issues. So who knows what could they do overseas? They could certainly have some overseas growth. But anyway, so is this similar to what y'all had? This tends to be one of the easier parts of it. All right, so we just have one part left on Thursday, and that's the hardest part. One of the hardest parts, the ROE discussions. So, all right, getting close. All right. All right, so really shifting gears here. This is very, very important. This is your application. So you're gonna see it twice today, and then you'll see it on the video prep. So we've got our assumptions built in. We're going to test on conversion rate because that was the biggest unknown here. So now we're gonna build this. And so I'm gonna build, and you're gonna do this with your team. With your team, we're going to meet once on your project to see how things are going. And then you're going to build your base case. And before you do anything else, you're going to meet with me on your base case. And we're going to go through that in a lot of detail. That's where I'm going to ask questions that like, why didn't you do this? What would you think about doing this? So you have an outside source somewhat testing you. You want to do that before you build any other cases, because if there's a problem with the base case, the best case and worst case are going to be messed up. So we're going to meet. So you'll see the process over the next couple of months. Pick your case, start getting the assumptions, meet with me to make sure everything's going well, build your base case, meet with me again. And at that point, you're pretty well to go. And good to go because I don't really need to see the best and worst case. Those usually fall pretty easily. So on the base case, the decision you got to make, and it depends on your project. Are we going to go across with time or go down with time? I normally go across with time, but I usually go down with time. So what we're going to do here is we're going to do something called the mid-year convention. So what the mid-year convention says is I have this benefit or this cost that is spread out over the entire year. It doesn't all happen at one time. If I use my time as one, when you do one as your discount rate, you assume it all happens exactly in 1 year. But you don't want to have to build every single month or every single day. So what we're going to do is say, hey, if there's a cash flow that happens evenly throughout the year, we're going to assume it all happens on June 30th, right in the middle of the year. And that'll kind of averages out. Right? Some of it will be before that, some after. But if we assume everything happens in the middle of the year, our discount will work pretty well. So essentially what we're going to do is we're going to start with our time. And what we do at time, now this is a little frustrating because it means every time you load your file, it's going to change everything. But I like to start with today. Did y'all know that today is a function in Excel? Today, open, close parentheses. And when you hit enter, it gives you today's date. I use that a lot on my dashboard. So when I use Bloomberg, I load it up. It says today, so it automatically updates the entire file to the day. And then we're going to go year by year, but year by year, we don't want to do exactly, 1 year from now, we do that plus 365.25. But if I do that, that didn't quite work. So I'm going to do 366 because it's leap year. If I do that and put a benefit in, then it's going to assume that, if you're like saving salaries, it's going to assume all those salaries happen exactly 1 year from now. So what I'm going to do instead of adding 366, I'm going to add 183. So find that midpoint between now and next year. Everybody understanding that? Now, what about the next year? When do the cash flows happen in the next year? Well, say June of the next year, halfway in the next year. That's going to be like a year and a half from now. Well, how far is that from 828? It's exactly a year from there. So your first date's going to be today. The next date's going to be 6 months from now. The next date's going to be a year and a half from now. All right. So there you can start copying down. And you'll have to decide what you're going to do with leap year because it does mess it up. But however you want to do it. I kind of like to have the exact same day there every time. You have to kind of decide whether you add 182 or 183. I like having the same day of the year each time, but it's not that critical. But Excel is picky. If you do leap year, it's going to be amazingly precise. So one extra day is going to change your numbers by 40, 50 bucks. So just be aware of that. Everybody understand that? We got our dates. Now what we got to do is figure out what categories we want to cross. So here, it's going to, every one of your projects is going to be different. But here, I want to know how many transactions I have. Now this is time zero. So time zero, you're not going to have transactions. So if like you're doing a franchise, time zero is just going to be the cost of the franchise. Your revenue and business, that's going to be the next time. All right. So here we're not going to have any transactions at time zero because that's just today. So our first transactions are going to be the next ones. So how many transactions do I have? Go back to my assumptions, and it said I have 80,000 transactions. But the next year I don't have 80,000, do I? The next year I have 80,000 times 1 plus the growth rate. Where's my growth rate? Did I not put growth rate in there? Oh, my word. All right, let's go back and find the growth rate. I left that out of the assumptions. How did I do that? I got to find it. How did I leave that out? It was probably in there and I just missed it. All right. Sorry, I left that out. You'll have to add that back. Expected growth is 4%. So I'm just going to put in an extra line there. Growth in transactions, 4%. And I don't know where I get that from. Maybe cash management. All right. Sorry about that. So you'll have that if you have a franchise. We'll talk about a franchise. Usually with a franchise, what I do is if you're doing revenue, the first year revenue, I have what my revenue be for the full year, but knowing I have a transition period. So I might say, okay, I would expect $1 million in revenue, but this is my first year. So my first year is only going to be 50%. My second year, 75% and 100%. But that $1 million is going to grow with inflation. So you'll see when we talk about that. But here we start with 80,000 transactions, but then we're going to grow that by 1 plus my growth rate. And then I have to lock it in with those dollar signs. So my next year is going to be 83,200. I highly recommend you don't use the round function. You might say, well, I can't do 200.637 transactions. I don't care. Just don't round. And you'll see why we don't round when we do the break even. When you do rounding, it messes up the break even. You can't find the break even. So I wouldn't round anywhere. Just let it go out a million decimal places. Now, how do we do the next few years? Well, you just copy that down. Once you have that locked in, I forget how many years we're going. Let's see. It says 5 years. We're only going to go out 5 years. The 5 years doesn't include the first year. Time one is, the first one is time zero. So we're going to go out 5 years. How many years will you go out? We'll decide that with each one of your projects. Like I said, with a franchise, you're going to go at least 10 or 15 years. Solar panels will probably go out 25 years. It just depends on what you're doing. But here we're only going out 5 years, mainly because the world's changing so fast in this area. Who knows what's going to happen? The next area is transactions converted. Right? Because we're not going to get all 80,000 of those converted to electronics. So how many are converted? Well, this is the base case. So we'll take the 80,000 times my assumption for the base case. Assumption for the basic case is 70%. So I'll lock that in. Once I have that, I can just copy that down. That 70% doesn't change. It's the same all the way throughout. So just all the way down, just taking each year. Now, what if you want to say, the first year we only convert 50%, the second year 60%, and 70%. You'd have to have each one of those years listed in your assumptions, and you have to line each one up. And that's certainly very, very possible. Then we're going to have FTEs saved, right? If we eliminate 56,000 transactions, we don't have to hire those people to do those transactions. How many FTEs do we save? Well, you remember in the assumptions, each person can do 20,000 transactions. So how about I get FTE saved? I'm gonna eliminate 56,000 in transactions. Each worker can do 20,000. How many workers have I saved in the first year? What math would you do? 56,000 divided by 20,000 or 20,000 divided by 56,000? How would you do it?
56,000 divided by 20.
Yeah, 56 divided by 20. Again, lock it in. I like if it's dollars, I do it in dollars. If the decimals don't really make sense to me, like transactions converted, I don't show the decimals. I know this last number has a lot of decimal places there, but I don't want to show it because one thing I've learned, especially with bosses, if you show all those decimals, your boss can say, well, you can't have 0.6237 transactions. And it's like, it's not important. It's, the math doesn't matter, but the last thing you want to do is walk into your boss's office and they get all fixated on the unimportant stuff. So formatting your file saves you a lot of that. You don't get those kind of debates. FTEs, I like to go out 2 decimals. Why? Because this is Carol's department. She can hire 2.8 people. Now, if you can't do that, if she either has to eliminate 2 people or 3 people, you can do the truncation. You can do rounding truncation, but I wouldn't recommend it here. Truncation, what it does, if it's 2.8, it just makes it 2. Rounding, it's going to round up to 3. So those have a difference, but we're not going to do that here. She actually can eliminate 3.03 positions. That's pretty amazing how she can manage her workforce. So this assumption is that each can do 20,000. So if we're going to eliminate 58,000 transactions, each can do 20, then we'll eliminate 2.9 people. Which one's this one? Yeah, so it's 80,000 times the 70% that we convert. Are y'all actually keeping up with me in Excel?
Yeah.
Students say, you're so fast in Excel. I said, if you think I'm fast, you're way too slow because I'm really slow in Excel. It's amazing how fast I've gotten. All right, and here we're going to do salary. Now, when you do your case, you can combine things in a cell or you can add extra columns. You've got to decide. I can do salary or I can do compensation. And I can't involve FTEs yet. I have to start off with per FTE. And the reason for that is I have to increase that compensation by inflation before I multiply by the FTEs. So I'm going to do compensation. You could do salaries and then do the benefits separately. I'm just going to combine them. So let me show you this formula. So their compensation per FTE is 50,000, but they're going to get an extra 15% for benefits, right? I could do the 2 separate columns, but I'm not. I'm going to take salary times 1 plus the 15%, and I'm going to make that their compensation. And that's in dollars, so I'm going to put a dollar sign. Now, the next year, that's going to grow with inflation. And all of you are going to have inflation, right? That's going to be real common. Your expenses are going to grow with inflation, your benefits, everything. So you're going to have an inflation assumption. So here I've got 57,500, but that's going to grow with inflation. And we said our inflation rate was 5%. So there's my pay there. So the first year I did compensate my salary plus 1 times 15% to get my total compensation. Once I had that first year, then I just add in the inflation rate of 5%. Now, for most, let's say you do a franchise. If you do a franchise, you'll probably have one column just for the manager and then one column just for the hourly workers. You do them separately, and then you have to decide how many hourly workers you have. It just depends. So there'll be different ways to do this. But a lot of cases, they forget that salaries is going to go up with some inflationary amounts. So you got to increase it. That's going to be inflation's part of your analysis. And so this is compensation saved. So if you're going to pay each of these workers $57,500, $57,500, and you're going to eliminate 2.8 of them, how much compensation are you going to save? What would be the formula here? Wouldn't it just be 2.8 times 57,000? Isn't that what you're going to save? And then that you can just copy down. And we left anything out. We look back on the assumptions. We got base pay, we got benefits. So we're going to ignore that. We got the inflation rate. There's no other costs or no other benefits. For your cases, you'll probably have a section on benefits and a section on costs, but we don't have any. The only cost we have here is the software development, and that all happens at time 0. So we only have one area of cost. So we'll add the system development. That one's at time 0. So remember, all of your cases at time 0, you have a big negative number. Otherwise, you did something wrong. And in fact, the net present value and all those functions won't work if you don't have a time 0 negative number. So what's our time 0 cost? I usually type it as a negative number. You actually need it as a negative number for the formulas to work. It's in dollars. So I'm going to show it in dollars. Questions up to there? And you already see how the best and worst case can be so easy. We only have to change one thing to do the best and worst case, and that's just transaction converted. Everything else is going to work. So once you get the base fixed, you can add scenarios. If you want to do 10 scenarios, you can do it really fast. You just keep copying things over. It's pretty easy. All right, then the next column we're going to do is the net cash flow, which here we just take compensation saved plus the development costs. So that's going to be our net cash flow. You just add those two together. For your cases, you may have several columns you have to add together or whatever. You got to make sure your net cash flow is a positive number. So this has to be the pattern, a negative number followed by positive numbers. If you have a negative number followed by negative numbers because your costs are greater, then it's not a project that's going to work. You know you're not going to want to do that. Why would you spend a lot of money up front to lose money? You also can't have a project where there's no upfront costs. So you have to have negative followed by positive. It is possible to have negative to follow by positive and another negative, but that creates some real tricky formula problems. All right, so now we're going to start doing our calculations, and we're going to let Bill Gates do most of the work. All right, he's rich. He should do something. So we're going to start off with the net present value.
Or like could you just put show formulas and then
Which column?
no, like just no, isn't it if you press show formulas, it shows you all of them?
Yeah, but it makes it tough for me to jump around.
Oh, okay, never mind.
I mean, if you need to see a certain one, I hate having to flip back and forth on that because I like to see the numbers.
Could you do the compensation? What's the one?
Yeah, it's just the $50,000 times 1 plus 15% for the first year. And then every year after that, you just increase that by 1 plus the inflation rate. So it's two different formulas, one for the first year. And this won't be uncommon for your projects. You usually get the first year set up. All the other years, you just increase with inflation. That's a pretty common format. And you can have multiple inflation numbers. You can have an inflation number for your compensation. If you're doing a franchise, maybe it's a separate inflation number for your food and beverages and all that kind of stuff. So you can have multiple ones.
Can you go back to the formula under E8 real quick?
Under which one?
E8.
Oh, 8.
Yeah.
May not be exactly as yours if you didn't put the assumptions on the same lines. So that's just 50,000 times 1 plus 0.15. I remember if I told you about one of the first projects I saw was the mail room at USAA, or the publishing room. They were hiring high school kids, and they said their compensation was over $100,000. And this was years ago. And I think, you're paying high school kids 100 and something thousand? They say, well, no, we're only paying them like 40,000, but we're adding all these extra costs. And most of the costs they were adding wouldn't go away if they eliminate those positions. They were all this allocation from other costs. So there's a reasonability, and I'll look at your assumptions. What would a manager or a franchise make? Do y'all know? Is that a high paid job? A McDonald's manager, are they making 20,000, 30,000, 40,000? What do they make? Now, you want some reasonability. What is someone working 40 hours a week at McDonald's going to make? They can make 15,000 a year, 50,000 a year. Have some reasonability checks in those numbers. These numbers, they look kind of high because this is not a college grad. $57,000, and it's years ago. But USA paid people pretty well. It's a fairly thankless job. The people who had this job hated the job, so you probably have to pay them a little more just because of the drudgery of the job. All right, so let's do net present value. So net present value, what we're going to do is we're going to take the value of each one of these cash flows in today's dollars. The value of the 565,000 is 565,000. The value of this is going to be $161,000, but discounted for half a year because we're assuming that it happens in half a year. We're going to take the 175,000 and discount it for a year and a half, for 2.5 years, 3.5, and 4.5 years. And our discount rate, I didn't put that in here, so I got to add the discount rate. So go back to your assumptions and add the discount rate. Our discount rate is 7%. That's not USA's discount rate, but we'll use 7%. That comes from CFO. So now we're going to do but you're not going to have to actually do the calculations. Bill Gates is going to do it. He has something he created. I got real excited when he created this because it's really cool. He has an MPV function. And that's the one you can actually use on your calculator, but it's not a good function. The function we want to use is XMPV, which is a really, really cool function. Those of you doing the fact exam, remember this. They allow you to use Excel, and this XMPV is a really good function to use because it tells you what to do. It's a lot better than a calculator. The calculator, you got to hit 20 extra keys for some reason. I've never figured out calculators, why you have to keep hitting these keys. But in Excel, what does it say the first thing we need? The rate. What's our rate? 7%. It didn't take it. It did take it, but I don't know why. All right. And then what's the second one? All right. Yeah. Bill Gates is doing something. Let me. So you notice here when you do this, it said assumptions be 11. That's fine because you always want it to be assumptions. But when I came back to base case, what did he do? He put the word base case there. You don't want that because what happens when you do the best case scenario and worst case? It's going to come back to this base case. All right. So I'm going to do this again. But if Bill Gates puts base case in there, I'm going to take it out because I don't like that. So I'm going to do this again. Equal X MPV. I need the rate. So go over to the assumptions and get the rate. Hit the comma. Come back and get the values. So the values are your actual net cash flows. But I don't want the word base case in there. So I'm going to take that out and just have it be the cells. All right. That's going to be real important when you copy it over for the other scenarios. And then what's the last thing he asked for? The dates. Where are those? Right there. Again, look up Bill Gates did again. Yeah, he visited San Antonio. My students were like, we got to make sure Sweet's out of town. They have to send security over. All right, so let's see if we all get the same answer. I'm kind of nervous.
Yeah.
Anybody get that? 245, 964. So what do you want with net present values? What net present value is telling you if this number is greater than 0, doing this project is going to increase the value of the firm. If it's less than 0, doing this project will destroy the value of the firm. So let's do our accept rejects. So accept reject, we're going to say if the net present value is greater than 0, comma, I'm going to say greater than or equal to 0. It's unlikely it's going to be exactly 0, comma, I'm going to tell it to accept. Otherwise, what I want to do, I want to reject. All right. So if that's the MPV rule. If it's greater than or equal to 0, you accept it. If it's less than 0, you reject it. I'm using the if function. I don't know. Do y'all use the if function? We overuse the if function in finance. I've had if functions that go on like 100 and 200 characters. Just go on. If this, then this. Otherwise, if this, then this. Otherwise, if this, then this. You can just go crazy. You're going to see that when we do the discounted payback. We're going to have to use a multiple if. How many of y'all got accept to show up there? Look good. All right. The next thing we're going to do is internal rate of return. So what internal rate of return is asking, we used a 7% discount rate and we had a really large net present value. What discount rate would we need to use? And what would happen to this 245 if we use a higher discount rate? Would it go up or down? Higher discount rate does what? The present value. It's going to reduce it. A lower discount rate would rise it. Their net present value is 245,000. We use 7% as a discount rate. The internal rate is going to be much higher than that. It's whatever rate makes that net present value 0. All right. And guess what? Bill Gates does it. XIRR. And again, he tells you exactly what you need. You only need 2 numbers. What's the first thing you need? Your cash flows. You notice here he doesn't say base case. That's because we haven't left the base case page. But always check that to make sure. And what's the second thing you need? Date. So you don't have to do the guess. We know it's going to be higher than 7% because the net present value is positive. But here we can see that I might go out 1 decimal place on that 24. Anybody else get 24.5? And again, we're going to do accept, reject. Now, internal rate of return, the accept is if the internal rate of return is greater than your cost of capital at 7%, you accept it. Otherwise, you reject it. So we're going to do equal if 24.5 is greater than or equal to the 7%, comma, accept, comma, reject. So that's the IRR rule. If your IRR is greater than your cost of capital, then you accept it. 24% obviously is a lot higher than 7%. So we're going to accept it. We'll talk more, maybe not next class, maybe next week. Well, we might next class. Which is better, net present value or IRR? Most textbooks say net present value is the better measure. They both have flaws. They both have problems. So we'll have to see both of them. But most managements like the IRR because it's a number they can identify with. It's like, yeah, 24% return. Wow, that's a great project. That sounds pretty good. Raise email. Who's got 24.5? Right. A couple of y'all. All right. You'll get to see. Yeah, you have another video to watch this as well, so you'll get it. And I may do it slightly different in the video because he knows what lines I put things on. So we'll see. You might actually come back to the class video. All right. The last one we're going to do is called discounted payback. So this project has a net present value of $245,000. But where in the time did it go from a negative net present value to a positive? Where in time is the net present value exactly zero? This one takes a lot of extra work. This is probably the hardest thing on the second exam. And so we're not going to be able to get this done today, but let me show you what columns we're going to need. We're going to need the cumulative net present value. And we're going to need the incremental net present value. And then we're going to do the hardest part, which is percentage of year used. All right, those are the three columns. It's hard to set up. It's complicated. The functions are messy. But once you get the base case set up, you got everything you need for the other cases. And the real nice thing is once you have column H, everything drops off of column H. You notice the net present value, the IRR, all this is going to drive off of that column. All right. The cumulative net present value is simply taking, you start off at negative 555. We might be able to get this built. We'll probably have to stop here. So what we want to know is what's the project net present value year by year by year. And so what we're going to do is do the equal MPV, X MPV. Our rate's the same, that's 7%. Our values here is just the first 2 years. And our years, just the first 2 years. What do I have to fix in this function? Take the base case. There's two things I have to do. Take the base case out. And there's one other thing I want to do. So at the end of year one, my net present value is still negative 149,000. So I want to copy this down, but what in here do I want to fix? When I copy it down is what's going to happen to the B11. So we want to lock that in, right? We always want that to be 7%. Well, how about H7 through H8? Do we want the H8 to go to H9? Absolutely. Do you want the H7 to go H8? No. What do you want the H7 to be? Always be 7. Okay. And what about the A8 through H7, the years? You want $7. That way, when we copy it down, we're always line 7. So what's going to happen when I copy this to the next year? It's going to give you a net present value for those first 3 years. Okay. When I copied it down, that very last cell better be $245,000. All right, because that's my net present value. All right, so we'll leave it there. We'll save it there. If you didn't get that, we'll do it again on Thursday. All right, questions on anything? I tell you what, I'm going to put the BF on the Canvas today, just in case y'all want to look at the rules for the resubmission, and then I'll resubmit it again. So I won't put this out there. This Excel file won't go out there because that's your homework. I mean, that's your application. That'd make it kind of easy for you to do the application if I put it out on Canvas. So that one, you're on your own. All right, I'll stop there. So as noted, Bob, BF is in line with the industry, though declining on turnover and very strong and stable on margin. You saw that in the percents, right? The change in margin was essentially zero over the time. As such, they are also very strong ATO tons margin, well above the industry, but due to declining ATO tons margin is also declining. The recovery in 2021 is encouraging. That's pretty strong. I don't know. I didn't say anything about COVID. It's possible. That's a COVID reaction. Watch closely in the next financial data releases. I like to say that a lot. If I see 1 year it bounces back, I want to know, is that a one-time thing or is this a trend? So, and that's the way Wall Street is okay, you're back 1 month, but or 1 year or 1 quarter, is that going to sustain? So, and to be watched closely next financial data releases to see if that is a sustainable recovery. The bounce back in 2021 puts them back in the top 10%. So that's strong. This carries over into ROE, except for some volatility in 2015 due to a jump in combined financial leverage, due to an increased issuance of debt. We talked about that earlier. With both combined leverage and ATO declining in the past few years, we can state that ROE is falling both due to weakened ATO, a bad reason, and falling leverage, a good reason. ATO is certainly the main issue I would want to manage to focus on. I said this last time, expand new markets or add new products. I'll try to find a firm that you can somewhat make up stuff. You know, it's not some industrial firm you never heard of. So not that I'm saying y'all all know this firm that well, but you can kind of guess the industry they're in. It's a retail industry. So y'all agree with that? Does that seem all right? The leverage coming down, that's good, right? Chart 16, lower is less leverage, less risk. Return on equity coming down because of that. That's a good reason for it to come down, but we also know it's coming down because this is coming down. So I went back and said, well, why is this coming down? And we saw margin was incredibly stable. So the only reason ATO tons margin is coming down is because of ATO declining. So you're just getting all the pieces and trying to figure out what's driving that line. And then you just make up things knowing about the industry, what they could possibly do. So, all right. So we're getting there. All right. Any questions on the exam? Let's finish up. We're getting pretty close. We're getting to the tough parts. So the discount payback, what we're trying to figure out is a time. The discounted payback is time, and it's when in time does the net present value hit exactly zero. We're not going to count times zero, but we're going to look that net present value get back to zero in year one. No, it's still negative. At the end of the year one, it's still negative. These are the present values that we're using. So you can't just add these two. These are undiscounted numbers, but these are the discounted numbers. At the end of year two, we're still negative. At the end of year three, we're still negative. So the discounted payback is going to be more than 3 years. But at year four, at the end of year four, we're positive. So somewhere between the end of 3 and end of 4, we're positive. We could just go in there and calculate it, but then each time we change something, we have to go back and calculate it. So we want to get Bill Gates to do all the work for us. So one thing we want to know is how much incremental NPV do we have? So we started at time zero with a negative 565. So at the end of the first year, our net present value increased. So we added 155. We added 161, but the present value of that is 155. All right. So all I did is I took my cumulative net present value minus the previous cumulative net present value. So that means the net present value improved by 155,569. We can do that the next year as well. This $175,000 2 years out, or really 18 months out, that value today is 158,000. So we added another 158,000. The next year, we added another 162. We went from negative 250 to 288. The next year, we added 165. And then the last year, we added 168. All right. So here's the hard part. And I don't know if I get this right the first time, but we'll see. There's different ways I can do it. And there's a good chance the video does it another way. But the first thing we know, so we're going to use the if function. You may want to wait till I get this at the end. I mean, you can try. So the first thing we're going to ask is if the cumulative net present value is less than 0, how much of this year are we going to count? We're going to count 100% of it. So that's pretty obvious. If the net present value is negative, we're going to count all of year 1. Okay. So the if function says if that's less than 0, 1, otherwise do something else. All right. So here the question is if the prior year was greater than 0. So if they are already positive the prior year, how much of this year we need? We don't need any. So that's going to be 0. So what are we left with? The current year is positive and the prior year was negative. All right. So in that case, what we're going to do is we're going to take minus the previous year. I'll explain this when we get this. Our incremental net present value this year. Now, I'm not 100% this will work, but we'll see. We should get a 1 if I did that right. We'll know as we go down. Yeah, that does look correct. All right, so let's look at it. We needed all of this year. Why? Because we're still negative net present value. We needed all of this year because we're still negative net present value. Still negative net present value. Then we come to this year. In this year, we started off negative 88,000. And we brought in 665,000. So what percentage is 88,356 to this year's 165,459? How far into this year you have to go until this goes positive, right? We start off with the deficit of 88,000. We brought in an additional 165,000. So it took us about 53% of the year before we went positive. So somewhere around 3.53 years, this project goes positive. All right. Now I know y'all going to say, I need to see the formula, right? So there's the formula. Let it sink in. The if function is incredibly powerful. Here you have an embedded if function. How many can you embed? I forget. There's a rule, but it's a massive number. You can do if this, then this, otherwise if this, then this, otherwise if. You can go on for a very, very long time. I don't know if anyone's ever gone to the full extent of if functions. I don't know what my own personal record is. I've had some pretty ridiculous if.
For the incremental MPV, for some reason it keeps coming up as a negative for me instead of positive.
Is your cumulative looking correct?
Yes, the cumulative is correct.
All right, so you maybe just have the wrong formula. So you need I8 minus I7. Is your I7 a negative number? Is anyone able to get those numbers? Nice thing is, once you get it built, when you do your team case, you already have it built. You don't have to rebuild it. The key, though, is to understand what we're actually doing. So we're trying to figure out where does it go from negative to positive, exactly to 0. It's somewhere between these two. We just got to see, okay, we brought 165,000. We needed 88,000. So we needed 53% of that. Anybody still need to see the formula? Who's got 111.530? A couple of y'all. All right, good. All right, so we'll go over and we'll do this kind of payback. And here all you got to do is you just sum up that column. That's all you got to do, just sum it up. Now, accept, reject, we got to go back and look at the question again. And I got to find. So what is their standards? So we look at their CBA policies. Let's see, here's the payback. They want to pay back in 4 years or less. Okay, so I'm going to actually put that into the assumptions page. Payback, standard. is 4 years, not $4, but 4 years. And that comes from CFO, I guess. We'll talk about your case, because on your case, I don't want you to have a payback standard, but we'll talk about that. So if we go back to the base case, here all we do is we say if the payback is less than or equal to the standard, comma, accept, comma, reject. And I did something wrong. Oh. So if that 3.53 is less than our standard, and our standard was on the assumptions page, then we accept the project, otherwise we reject it. I got that. All right, let's talk about your projects. So what I strongly recommend on your projects is that you don't have a payback standard, but you calculate payback. It gives you something to talk about. There are a few cases where payback makes no sense at all. So let me give you an example. I've had teams do like a real estate project. They're going to buy a house. Instead of putting their kid in the dorm, they're going to buy a house near campus, rent it out. When their child graduates, they're going to sell that house. So in 5 years, they're going to sell the house. Well, when's your payback going to be? Your payback's going to be the day you sell the house. You're going to be negative, 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 and then it's going to be exactly when you sell the house. All right, so payback on a real estate project like that doesn't even make any sense. It's nonsensical. Another thing you're going to find with this is what is your payback if the project's a negative net present value, if it's still negative? This formula is going to give you ones all the way down, right? So you'll get 5, but that's not your payback. What's your payback? You'd have to keep going down more and more and more years until you actually find the payback. So if the net present value is negative, you can't get the payback from here. You'd have to go more years. And I actually recommend you do that. So if your net present, let's say on the worst case, your net present value is still negative after 5 years, go out 6, 7, 8, 9 years, see what that payback is. So you have it to talk about. We'll talk about that as we get into your cases, and I'll help you as you do your cases. So there is times when payback just makes no sense. So real estate projects, we don't talk about payback because you got to sell the house. So your payback is going to be exactly the date that you sell the house. All right. For others of you, one thing on franchise, payback's pretty important to me with franchise. So I don't have a standard. What I'm trying to do is I want a franchise that the payback's pretty fast. That to me is a big criteria. That's almost more important than the return I make. I want a franchise, I get my money back faster. And there's some franchises that do that really, really well, and some franchises that are really slow. So in 8 years would be great. 13, 14 years, that's pretty horrible. So if I was looking at 20 franchises, trying to figure out which one I'd want the one whose best case, worst case, payback was in the best, smallest, lowest range. So that would be one of my standards. So payback can be useful, but I don't want you to have an accept or reject on payback. I just want you to calculate it and discuss it for your case. All right. Now what do you do? Well, we're going to do, so we do worst case first or best case? So give me the bad news first. Okay, worst case. All right, so here's where I told you it's really, really important. You don't have base case in your formulas anywhere. I think we got rid of all of them, but you want to make sure, because when we copy this whole thing, you can sort of go up to this little triangle and hit Control C, go to your worst case and just hit enter. We got to make sure the word base case is not anywhere in here.
Like in
any of the formulas, right? You might be able to do a search to make sure, but just to make sure it's not, I don't think it is. I think we got all of them. The best thing to do is to catch it as you go. So you definitely don't want base case, because then this will be referencing the base case rather than referencing this worst case file. And so how do we do the worst case? Well, the worst case, the only thing we change is transactions converted. So instead of assumptions B5, we're still instead going to do assumptions C5. And you have to lock that in.
Wouldn't that be your?
D5, right? Your 50%, and then copy that down. And now you're done. You have your worst case. That's how easy the worst case is to do. We'll talk a lot as you get your team cases. We'll talk a lot about how to do this worst case, best case. You have to have a really good function to do that on. So with franchises, it's almost always revenue. How many customers are you going to have? For real estate, it's almost always what that resale value is going to be. Although I'm going to show you a really cool thing you can do with a real estate assumption. So everything's already done. It's still accept, but not much. The internal rate return is still accept, but it's just barely over our cost of capital, and the paybacks reject because it's 4.88. But you're done. Once you change that, Bill Gates does all the work and you're updated.
That's weird. Mine didn't.
I'm going to take out the mid-year convention thing. We don't need that in there. All right, now let's do the best case. Mine's up there before, so we can just copy the base case again. Just hit enter. So all we have to do is change transactions. So instead of B or D, we're going to use C. Copy that down, and we're done. That's why we like Excel, right? It does all the work for us. You see why I want your team to build your base case first and get it signed off by me before you build the other cases. Because if you build the other cases, there's a big problem. You have to almost restart from scratch and just delete those. All right. Anybody having trouble with that? All right, we have one last case to do, and that is break even. So I'm going to take the base case again. I'm going to copy it over. And I'm going to do a break even on transactions converted, but to do the break even, I have to have that assumption on this page. So transactions converted. Let's start with 50%. And so here on transactions converted, instead of going to the assumptions page, I'm going to reference this. I'm using 50% because that was my base case, so I'm in my worst case, so I can somewhat double check the numbers. So it should look exactly like your worst case, except for you're referencing transactions converted on the break-even page rather than going back to the assumptions page. Right. So the definition of break-even is what assumptions for transaction converted would give us a net present value of exactly 0. So here I'm going to do data, what if analysis, goal seek. If y'all use goal seek, it's a powerful power tool. So what do we want? We want to set the net present value equal to 0 by changing the conversion. And there it is. If we can convert at least 48.77% of our transactions, this project makes sense. Our worst case was 50%, so we're just barely above that worst case. You know, the worst case is just barely above the break even.
What was your goal seek again? Set cell ED2 to.
Yeah, so you do data, what if analysis, goal seek. You want to set your present value, D14, equal to 0 by changing your transactions converted. Now the key on the break even is you can see I only have one thing I'm changing. What if you want to change multiple things? I'll give you an example of that later. We'll look at what I do with real estate. So it is possible you can have a break even when you have more than one factor, but they have to be correlated to each other. And you'll have to see that. So
If I'm gonna pause it, and then it's freaking out and giving me like,
are you on Mac?
no.
Yeah, it should work. It's possible it won't work if you have the base case still referenced in your file somewhere that, there's things that could throw it off. Here's where I tell you don't do any rounding in your spreadsheet. Because if you do rounding, the break even may not exist. So you're best not to round, let things go out multiple decimal points, and then it should give you the break even. Anybody got the break even to work? A couple of y'all? All right. So I love what if analysis. There's a better one out there though. If you haven't added it, under options on add-ins, Excel add-ins, you definitely want Solver, and we'll use Solver maybe some in this class, but Solver is a really, really powerful tool. They don't automatically add it in there because it makes Excel much slower loading, but you really want Solver. There's also the analysis toolkit that I would add as well. Y'all probably use that in some of your classes, haven't you? So that's really powerful. You might as well just, I don't know, the Euro conversion tool, but yeah, Excel has some really, really powerful tools. I use Solver all the time because in finance, we're always looking for the optimal, what's the best solution? You have so many factors. Could Solver work in a CBA analysis? It could. You'd have to really do some setting up to make it work. This break even lends itself very, very well to do the goal seek. But Solver is a really powerful tool, and it's pretty straightforward to use. All right, so the last thing we're going to do is before the base case, I'm going to add a sheet. I'm going to call it summary. Now, when you do your presentation at the end of semester, I don't need a fancy PowerPoint. You can do that if you want to, but I actually prefer you just to present your whole case from the Excel file. And you can add sheets. You can actually type stuff up real fancy in Word or PowerPoint and just take a picture of it and put it into the Excel. So you're doing everything from Excel. So you can kind of make both Excel and PowerPoint by just putting pictures in there. But the summary chart is probably what you're going to start with. I mean, you can probably introduce the project, talk assumptions, and then the summary. So how do we want to do the summary? So I want to have some key information. So I might say net present value, internal rate of return, discounted payback. And then what else would be a good summary? Well, what was the key factor in this case that we're so interested in? Percentage transactions converted. So I think that would be important as well. And so up here, I'm going to do base case. I'm going to do best case next. I like worst case and break even. I do like all the columns to be the same width. So here I'm just going to go get my numbers. The base case net present value is 245. The best case is 477. In the worst case, 14,000. And then the break even, I'm going to put it in there, but we know by definition what it is. All right. Now, would you show it to your boss like that? Does that look good? I have students that submit papers like that. What's wrong with this? You're gonna format it. What is the 245? Is it percent? Is it times? What is it? Well, it's dollars. Do we need pennies? No, we don't need pennies. All right, so put all that in there. The nice thing is the IRR is right below that, isn't it? So we can just copy that down, right? We put it right below. What is IRR? Is it dollars? Isn't that a percent? And in payback, where do we put payback? Right below it, right? Now here's where you got to be careful. If the net present value is negative, the payback it's going to come up as 5 years because it's going to say you still need a year. But if the net present value is negative, payback is not good. So we're probably going to have to add an if function. If, well, I'll tell you what we'll do. We won't do it here. Let me show you where I'm going to put it. I'm going to go back to base case here. I have a problem. So I'm going to do it here. I'm going to say if I'm on the base case, if the net present value is less than 0, put not applicable, comma, sum all of that. All right, so if it's negative, it's going to give me a not applicable. If you want to, maybe don't use such. NA could be not applicable or not available, either one. All right. So if it's positive, it gives you that, but if it's negative, it doesn't. So I'm going to copy those over to my best case, my worst case, and the break even, it doesn't really matter. We can copy it over there, but it doesn't really matter. All right. So now when I do the summary, if my worst case was negative, it's going to give me an NA there. Because it gives 5, that's confusing. Well, your net present value is negative, but your payback's 5 years, but you only went out 5. It doesn't make sense. So if your net present value is negative, you shouldn't have a payback. You notice on break even, I'm not showing that. And that's because my definition of break even is a net present value of 0. You know that the IRR is going to be 7% because that's the cost of capital. You know the payback is going to be 5 years, so it's kind of redundant. So the only reason I'm putting the net present value there is for definitional purposes. I want my boss to know my definition of break even is a net present value is 0. And then the percent converted that we can get from the assumptions, 70%, 90%. And where do I get the break evens transactions converted? Well, that's on the break even page. All right. Any question where I got anything? You're going to have this again when you do the application. And then fancy it up however you do. Fancy it up. Absolutely.
Thank you.
You know, decide how you want to do it. You can have a big outside border. I have a column that doesn't mean anything. I'm just going to highlight that. You can get fancy here if you like. You know, however you want to do it, but, you know, make it look like a good chart. So net present value is positive, even in the worst case. Internal rate return is very, very high. The payback is acceptable. Now, here's another place where if you wanted to, I've had some students do that. If you can put it in green if it's acceptable, and red. So maybe this is the one thing, you know, it's not acceptable. So maybe you would highlight that's the only one out of this whole thing. That's the only thing that's not acceptable is that payback. However you want to identify it, that works. So does this look like a project you would approve or not approve? Yeah, when I finish this analysis, I went to Terry, Terry, I finished the analysis. I don't know what you got to do to get it approved, but let's do it. Let's do it as fast as possible. This is a really obvious project. to do. The people working in this area hate this. They want to go back to Carl's department. It's messing up the customers. They're getting all these errors in their reports. You know, there's all kinds of reasons to get this done. Let's just get it done as fast as possible. So, question?
Yes. I think my associate really good under FTE, so I think it's not changing much.
Yeah, you don't want the word base case in there at all. Yeah. Yeah, I mean, so he had his not working because the base case word came over. You might try doing a search on the word base case and see if it identifies, because that might be a way to check. You should be able to, I think. Sometimes search functions don't look at the formulas, but you want to make sure it's not in there. So some way to finalize it. The only other part of your case, once you do this, since you have the case, the only thing left are the intangibles. So you'll have a page of intangibles. By intangible, we're not talking about intangible assets like amortization and those kind of things. We're talking about those things we haven't put dollars to. Intangible benefits, intangible cost, and you'll just list those. This is where you probably want to do it in a PowerPoint or Word and just paste it into the Excel so it works. So employee satisfaction. That's the one thing I noticed immediately, how much the people working in this area hated this job. They'd much rather go back to the other department, much more automated. Customer satisfaction. Lower customer error rates. Those are intangible. Now I could say I'm saving FTEs, but that's not intangible because that's in my numbers. Right. So if it's in my numbers, it's not an intangible. So you don't want to say, hey, it's saving us 2 FTEs. Yeah, that's already been valued. So we're looking for those things we didn't value. Could we value this? Employee satisfaction. Could you put a dollar on that? You could. Be very, very subjective. Customer satisfaction, you could. Lower customer error rates. That is hard. It's easier to measure, but harder to say in dollars. But you could certainly measure it. If you know what your current error rates are, then you can see what they are afterwards. I don't even know if they knew because it was just such a mess. Intangible costs. I have no idea what that might be. So yeah, we couldn't think of anything negative here. What if you're doing a franchise? So employees, to me, let's think about a franchise. The reason I want to talk about this is intangible costs and benefits is usually the lowest score on the case for almost every group. So if you're a franchise owner, what would benefits be? Well, I mean, one is you're an entrepreneur. I could never spell the word entrepreneur. Control. I think a lot of people like being a franchise because they're their own boss. They have their control. They can do things they want to do. It could be impact community. I know some franchise owners, they love hiring high school kids from the community and helping them develop, giving them responsibility. You could have special community projects that you could do, those kind of things. You get creative implications. If you're on your own business owner, you get to do whatever you want to do. You don't have to, you're your own boss. So anything creative you want to try, you can certainly do that. Intangible costs is a time commitment, something always an emergency. There's always something going wrong. We have franchise. People don't show up to work. A truck doesn't deliver. food on time or drinks on time. I was eating at Neater. I was mentoring this high school kid who wants to be a finance major. So I was in a program with him. So we met at Neater's. Neater's is a nice restaurant, but their ice machine was broken for like 6 weeks, 7, 8 weeks. What a mess. Just frustrating. Well, the employees work it out somehow, but they didn't have a really good solution. But it took them forever to fix it. That's just you as a franchise owner. You come in, 4 weeks later, you go, wait, the ice machine's broken. Yeah, it's been broken for a month. It's like, well, that's pretty bad. That makes customers really upset. We need to fix that. So there's always things like that going on. Could any of these intangibles be priced and moved into the case? There's one of them that definitely could.
Time commitment?
Time commitment. It's going to cost you 50 hours a week. Could you figure out what your time's worth to you? $50 an hour, $100 an hour. That you could actually put into the project if you wanted to. On something like that, I might do the project without that and then do it again with that. So it might be positive net present value if I don't have my time commitment. When I throw my time commitment in, this project's not worth it because I can find other things to do with my time that's worth a lot of money. So yeah, that's possible. How do you figure these things out? You might find an entrepreneur, a franchise owner, and go talk to them and just ask them what they think. What do you love about this? What do you hate about this? What's the frustrations? I will already tell you, all of you, on your projects, one of your resources is going to be YouTube. Here, all you got to do is just go Subway franchise, and let's see how many negative things come up. Is Subway franchise worth the investment? Should you invest in a franchise like Subway? Look at all this stuff. The rise and fall of Subway, how to buy franchise. So there are, I don't know how many came up. I don't know if they tell you, but YouTube is a wonderful, wonderful source. If you're researching your firms, you can type your firm's CEO's name in Subway and see what they're saying about the firm. It's just amazing. YouTube is just an amazing resource. But especially for franchises, there's always going to be someone talking about the franchise if it's a meaningful franchise at all. I think Orange Theory is in there. Very interesting franchise. Is it legit or not? You're looking for the positive, but also the negative. So if it's coming from the company that's pretty biased, you can certainly look at that. But this is a wonderful source of those intangibles. What are they talking about? That's a headache to doing this that you hadn't thought about. So what a lot of teams do is the day before the case is due, they run in and throw a bunch of stuff down. You don't want to do that. You want to have someone on your team that's out there actively looking for stuff, ideas. I want to see how creative you get at thinking about this. Some of them are obvious, but there's others that might not be. So intangibles go in there, and then you have your final summary. So in your final summary, you could have key intangibles considered and have that in your summary page. You don't have them all, but you have the key ones. These are ones that really would influence your decision. So on the summary page, you have it. So what's the one last thing we haven't done yet? We got to link everything. Summary analysis. Where did we put it? Link in this document, go to the summary. Supporting assumptions we're not actually doing that one. Base case, just link it. Best case. And what most people do on the base case is they have a link back to the assumptions page. But you're probably going to be jumping back and forth between that, and then you can just copy that. Because if you copy it over, it keeps the link. So that's kind of nice. So we didn't have any supporting assumptions, but you could even have multiple of these. You could have assumptions where it had a list of 4 things, my CPI assumption, my rent assumption, whatever. And you could have a link to each one of those. This makes it really easy when someone comes in and say, well, I just want to see the summary. That's all I need. And it goes right to that. What is the summary linked to? Who knows? I'm thinking with the summary, I might want a link on the summary to each one of those as well. So, I might. I'm not saying you have to do all of this, but I might, I'm on here and say, wow, that worst case, boy, that looks terrible. I'm going to go over and look at that. Oh yeah, I see what's going on there. So you have to kind of decide, you'll decide over time as you work with your file where you're jumping from. That's with my charity, with the hundreds of sheets. I've learned over time how to do the links, so I don't have to go page down, page down, page down, over and over and over again. It's just a lot less work. All right, so you'll be getting this practice. Once you get this built, it could be your main file for your case. We'll talk about some other cases. We might on Tuesday, I know we got the exams here, all stressed, but we might on Tuesday do some team time of y'all picking your case. Have any of your teams talked about your case yet? You're too stressed about project 1 and exam 1. Is Tuesday too early? I'd like for you to really have a good idea before you go to spring breaks so you can start thinking about what you're doing. So we might on Tuesday break up. We'll go through the list of, in fact, why don't we do that now so you can be thinking about that, and then we'll finish.
The exam is Thursday, right? Not Tuesday?
Thursday, yeah.
So what are we doing next Tuesday?
Well, let me show you. You can see it. All right, let's look at these so y'all can start thinking about this. So on Tuesday, we'll spend some break time thinking about this, but these are ideas that you could use. So solar panels, obviously that's a big deal now. I heard one guy who actually put a wind turbine in his backyard. I wouldn't think that would be a great idea. The numbers didn't look very good, but solar panels, you see those in San Antonio. So with solar panels, it's kind of boring just to do solar panels in San Antonio. So where it gets interesting is electricity in San Antonio is a lot cheaper than in Austin. So I would do a contrast between Austin and San Antonio. What you're trying to help people understand is what are those key factors that make sense. So what city you live in matters. The geography, where you are in the country matters. Which way your house is facing matters. How many trees you have in your yard. I had a team last semester do a really exceptional analysis on what are all those factors are a key for solar panels. But what's changed this year is the tax law, the Biden, whatever that thing is called, the Inflation Reduction Act, our IRA, that has some pretty strong tax incentives for solar panels. So solar panels have not made much sense in San Antonio. It's barely even break even over 25 years because electricity is just not that expensive in San Antonio. But with these tax incentives, it might make sense. I thought about adding solar panels at a private school I was helping with, but the tax break went from $100,000 to like $3,000, and that was enough to kill the project. It didn't make any sense at that point. So you could do that, but you have to think about on this. You got to be very specific. And the key is you want to be able to help someone make a decision. That's how I grade the case. Help someone make a decision. So someone may not have a house exactly like the one you're doing, but how can you help them say, here's the other factors you need to look at? The intangibles there is going to be, you know, you're helping save the world, whatever you want to, however you want to word that. I love this one. This was kind of mine. What I like about electric cars and hybrid cars is I'm convinced plug-in hybrids are the way to go. But no one's talking about that. People want EVs. Well, what do you hear with EVs? Is charging, long trips, where are you going to get to a place? You get to the charging stations and they're all broken, all those kind of things. So you're hearing, or in California, they're telling people we don't have enough electricity, stop charging your cars. So I like comparing an EV to a plug-in hybrid because I think plug-in makes more sense to a gas car and kind of see those. How do you do a case like this? So the cost for this project is not the cost of the car. Cost of this project is how much more the EV costs versus a gasoline car. So you're not going to do a net present value of a gas car, a net present value of an EV, because it's going to be negative. Buying a car is a negative net present value. You want to ask if an EV costs $5,000 more, is it worth to spend an extra $5,000 to get those gas savings? All right. So for me, my EV, my plug-in hybrid, probably would have been about $4,000 more than I would have spent for a gas car, but I bought it 1 year used, so it was the same price. And EVs, these cars last longer, so I kind of figured I was ahead of the game, and it saves me about $50 a month in gasoline. So it wouldn't work well for a project because there was no upfront costs, and I had all these savings, so you'd have to set it up correctly. So how do you compare all of these fully electric cars? The trick is going to be finding comparables, because obviously a Tesla is a pretty nice car. You're getting more stuff than just the electric engine, and that has some value to it. So you have to kind of think through that. But franchise, you can do all kinds of franchises. It doesn't just have to be a food franchise. You can do that. Driverless car doesn't work too well, but I actually, when I was working at UTSA, I spoke to the risk management department. What does autonomous vehicles mean to the auto insurance industry? I think if it ever does take off, that people will just stop buying cars. That we're going to be doing apps on our phone and a car just drives up, picks us up. You might own one car instead of two or three, so it may cut down how many cars, especially if you eliminate the driver for Uber and Lyft, which sounds terrible, but if you eliminate the driver, the costs go down about 75%. That's when it makes sense for a family that had two cars to get rid of one car, and Uber becomes their second car, and they just hire Uber. What does that mean for USAA? It would certainly have a huge impact on the business. You could certainly do that as a case. So there are some real estate projects that you could do. I think college students make a big mistake buying a house right out of college. I don't recommend you buying a house in the 20s. Is buying a house a good investment? I say no. Warren Buffett just said no. Buying a house is not a good investment. That word investment's the wrong word. Is it a good lifestyle choice? It can be, but the net present value is going to be negative. Why? Because if you buy a $300,000 house and own it for 30 years, you will probably invest $500,000 into that house over its life. And most people don't put that into the numbers, but it's a pretty bad investment. But when you're doing some projects where you have some extra income, like you rent out part of the house or do something, you buy a dorm, you live in one half and lease out the other half, those kind of things, you can get some interesting real estate projects there. So there's a couple in there as ideas, like, you know, instead of buying a house, buy a duplex and rent out half of it, so you can at least get part of that land and that building and infrastructure paid for by somebody else. Now, I had one team do a project, I can't remember the name of it, but it was buying cars and leasing them out. I forget the name of the firm. That was a pretty interesting project. I had, huh? How do you spell it? Yeah, it may be. Yeah, I think that was it. Yeah, it was interesting. I didn't know they had that. I had heard of RVs, people buying RVs and leasing them out. I thought it'd be cool to do a cross-country trip in an RV, and so I looked up to see what it costs, and it was more expensive than a really nice hotel. And it's like, no, I'd rather fly in a really nice hotel than drive an RV and spend the same amount of money. But I mean, there's some interesting things out there that you can buy stuff and lease them out and get some amazing benefits. This one was really interesting. I wanted to do this at USAA. They wouldn't let me touch it. USAA had 2 corporate jets, really, really nice corporate jets. One of the pilots was a former Air Force One pilot. I wanted to do the cost benefit. They wouldn't let me because they were like, it's going to look so horrible. I thought USA used the corporate jets extremely well. I flew in it several times. It saves you a lot of time. We did one trip. We went to 3 different cities, and the whole trip took 2 days. If we'd been commercial, it would have taken us 3 or more days. It saved us a lot of time. And on the flight back, we were visiting banks. On the flight back in the plane, we had a committee meeting. We made our decision. We wrote up the presentation. We landed, and we had the entire project done. If we had been in commercial, that wouldn't have happened. I had a team that was working with Constellation and their expansion into Mexico, and they're using a corporate jet, and they made a case that the corporate jet made some sense. But that's possible. The problem with a project like this, and keep this in mind if we do this on Tuesday, this is a project. It's very difficult to get the data, to actually get the data to do the analysis. So tough project that way. Yeah, I wish one of y'all would take this, and I could even call my endocrinologist. His medical office is horribly managed. And some of your management majors, they do stuff that is so ridiculous. Like they call every patient a few days before their appointment and say, we're calling to confirm the appointment, which of course they get voicemail. They say, please call to confirm. You call back, they're not there. There's this, what could they do? Where there's firms out there for $40 a month, they'll do that all with text, off the computer, and they could save. I was telling my doctor, you could save like 3 or 4 people by doing this. So I wish one of y'all would just, I'll call my endocrinologist. Hey, we let a group see if they can improve this. I forget the name of the firm. There's a business breakdown podcast on this firm. I was listening to it, and I was like wanting to email it to my endocrinologist because it makes a whole lot more sense. I wish one of y'all would do this. I think we talked a bit about this, but automating the jury selection process, that would be pretty fascinating. If any of y'all have connections with the district attorney or anyone else, that would make some sense. Kiosk, we had 2 teams do kiosk. We have kiosk over in the food court here. I've never used them. Have y'all tried those? The Chick-fil-A and I've noticed the Subway, people will call Subway, and it does seem like it's faster to do that. But what does that say? We had one team do a kiosk for HEB for pharmacy. That can certainly be a case. Here, boy, I love this one. Y'all should think about this one. This is a really incredible one. You may not like this guy, Lomberg. He's a little bit political, but they did a study on where governments should spend their money to get the best social bang for the buck. And they do some really interesting projects. The nice thing about this, if you want to look at education, they're talking about how can you help emerging countries improve their educational systems. All the data is in the report. So essentially you take the report and you can check the data and everything's there. It's complex. So he looks at all these childhood immunization, and these are cost benefit analysis. He's looking at the costs and the benefits. He gives you all the data. So there's a lot there. It's a really good report. So on Tuesday, we're going to spend some time. It'd be best, we won't use the whole class, or maybe the last 30 minutes or so. So if your team decides in advance, then you could probably leave early, but you probably won't be able to get together. So, all right. So start thinking about it.